welcome. Thank you for being here.
Of course. Thanks.
So none of your firms really need any sort of introduction. I did learn a fun fact that Ty and Mike actually started their careers together as analysts, so that's pretty fun. But why don't we just start, given that we're here to talk about credit, if you just take a minute to explain what your firms do or don't do within the credit space. You can just go down the line.
Sure. Mike Arougheti, CEO of Ares. Great to be here. Ares manages about $430 billion of assets, about 75% of which are in some form of credit instrument, largely focused on the private credit markets in corporate lending, real estate lending, infrastructure lending, structured credit, et cetera, with active teams and strategies in the U.S., Europe, and Asia.
Ty Wallach, I'm the CIO of credit at Atlas Merchant Capital. We focus on corporate credit across North America and Europe, up and down the capital structure, everything from senior secured debt down through equity. We tend to focus on companies that are below the radar of some of the bigger guys up here on the stage with me. And we just try and be opportunistic and focus mostly on liquid credit these days.
Hi, Dan Loeb with Third Point. We have a multi-strat fund that invests across the capital structure. About 50% of our equity is in credit, both structured and corporate. We have some standalone funds and are starting a private credit fund to join the party sometime this summer.
So when we talk about distressed credit, I think common that you hear narratives that are sector specific or, commercial real estate being a good example. But Mike, you've been speaking about how we're not really in a period for operational distress, but it's actually liquidity distress. Can you paint that picture for us and explain what you mean?
Yeah, so if you look at most prior cycles where we've had meaningful distressed opportunities, it's been caused by some form of fundamental economic pressure or the combination of some kind of formal economic pressure and liquidity stresses. And typically that's been harder to invest in my opinion, just because you're chasing rates down and giving up return while you're trying to structure your investment, and you're chasing your earnings down at the same time. Today, when you look at the strength of the underlying economies that we're all investing in, the picture is quite different absent what's going on in certain sectors of the real estate market, which is to say that we're seeing strong economic fundamentals, good companies, but with bad balance sheets. And so a lot of their free cash flow is just simply going to pay higher cost of interest. And that's a unique setup because you've been accumulating excess return because of base rate. You're not chasing earnings down and you're not chasing rates down, but what you are doing is getting an opportunity to bring creative capital into these companies at very high rates of return to try to give the ownership the runway they need to either reaccelerate growth or just, buy themselves time. So it's there's a certain sense of calm, I think, when you're investing in a market like this versus one where there's a lot more volatility.
Ty, do you agree?
Yeah, I totally agree. It's funny for those of us of a certain vintage who go back several cycles. A lot of the distress cycles that we've seen in the past were focused on particular industries, whether it was the telecom kind of boom and bust in the early 2000s, you had the financial crisis, you had energy in kind of the mid-teens, and a lot of the distressed opportunities at those times were concentrated in those industries. Today, because it's more rate-driven than operations-driven and specific industry-driven, you are seeing that proverbial good company, bad balance sheet opportunity that Mike talked about, and I think that's great for a portfolio of distressed as we see more and more names that offer good returns and really just the opportunity to fix a balance sheet, because that's what those of us up here are much better at fixing balance sheets than we are at fixing companies.
Right. Dan, we're in this period of higher for longer with the rate environment. What do you make of that, and what does it mean for the opportunities in distress?
I agree. I agree with what Mike and Ty just said. The only thing I would add to that is kind of adjacent to the distressed opportunity is the stressed opportunity. I'd say since 2009, about half of our investments have been distressed. The other half have been bonds that are yielding maybe 7 or 8%, 9%, but have some opportunity for tightening. So I wouldn't call it distress necessarily, but the sort of opportunistic tactical trading where you're betting on an upgrade or refinancing or something that will tighten the spreads. So I think that's what we're seeing, a lot more of that now. And frankly, up until now, there has been a dearth of the distressed opportunities have been sort of spotty. So we, by definition, had to pivot towards more of a, performing credit, but tightening type of strategy.
I think the structure of the market has fundamentally changed too from when we started doing the business, which accounts for some of what we're seeing as well, right? If you go back 30 years and you just think about the structure of all of the liquid markets, both debt and equity, you had the opportunity for information advantage or asymmetry of information. The banks were playing a much heavier role intermediating those markets, and so that there was opportunity for inefficiency. When you look at what's happening now because of the growth in privates, we're seeing a lot of situations where 20 years ago we would have, bought a bond from 80 down to 40 in an effort to get to a restructuring. And now it just never will get there because when it gets to 70, it's getting restructured in the private market. And all the while, I think the cost and time of a bankruptcy has gone up dramatically to the point where the calculus is different. So it has fundamentally changed, which is why I think I would echo your comment that structurally there's as much opportunity just kind of playing within that range of outcomes than there is trying to go for a full restructure in a lot of these situations.
Absolutely. I think part of the reason for our launching our private credit fund, other than having, another opportunity to create a business that has a great underlying return profile, is having access to that universe of potential distressed opportunities so that we'll have a team of people that are looking at that. And I think that's absolutely essential. $1.5 trillion market growing mid-teens every year, something we can't ignore.
Yeah, I think thinking about the structure of the market and banks more broadly, do you think that this is a long-term change? The market's adjusting to a longer, higher rate over time. We have just in general, the adjustment to the higher rate, is that influencing how?
I think if you look at the modern history of the financial market, zero interest rate policy was the exception, not the rule. And we all used to live in a world where 3.5% neutral rate was kind of, standard. So the idea that we're going to adjust back to something with a 3 handle on it should not be a surprise to folks. But you have some, countervailing things happening here. You have, policy rates which will come down. You have more significant central bank intervention and fiscal policy, which is going to probably anchor us on higher rates at the long end of the curve. And then you have real, what I would call structural challenges that have been exposed once again in the banking system, over the course of the last year. And we're not done with that. And so I think the combination of continued consolidation in banks, continued regulation, and then the shift in the policy rate will keep this opportunity not just growing, but I think, offering pretty outsized returns for the foreseeable future.
Yeah, let's dig into bank consolidation a bit more. I think, correct me if my numbers are wrong, but we have 4,000 banks in the United States. The next largest is 100 outside of the US. So you have SVP, you have PacWest. In general, too, I think that with, to your point on the structure of the market, you have this, the media loves to pit private credit against the banks, right? But there's still an element of partnership in there as well. So how do all of these factors play together?
I'll give my quick 2 cents. You guys should chime in because I think the way banks are playing in the agency side of the market is also fundamentally different. The narrative of banks and non-banks competing, I think, is just headline grabbing. No one is actually viewing it that way in the trenches. The reality is, if you look at the structure of bank balance sheets, there's $23 trillion of assets sitting on bank balance sheets today. There's an overabundance of commercial real estate loans sitting with regional banks that need to get resolved. And at this moment in time, the private markets through structured credit and other instruments are actually coming in to help restructure those balance sheets in a way that's good for the banks. And if you look at that decrease from 8,000 to 4,000, you'll also see a pretty significant secular decline in just normal C&I loans. The fastest growing segment of bank balance sheets over the last 20 years has been loans to other financial institutions. And so all that's really happened is that the banks have become capital providers to a broader set of private market players because they're taking less risk and they're getting better regulatory capital return on it. And that's also helping to spur the proliferation of the private market. So it's not as though I think any one of us goes into the market on any given day and feels like we're competing head to head with a bank.
Right.
Yeah, I would just say since, what's changed the most since I started my career is like banks used to lend into the corporate market and they don't really do that anymore. They syndicate. And even the syndicated markets are taking a back seat in many cases to a lot of the private lenders. And, we've seen as bank consolidation has occurred, you have a lot bigger banks. As private lenders have raised more money, they're now focusing what started on, correct me if I'm wrong, when you started, you were probably focused on middle market companies.
Yep.
And now you're not. And what that has created is a lot of money chasing the big deals. And that's precisely why our strategy focuses on companies that are kind of $2 billion and below, because, I feel like that is a little bit of an underserved market. It also happens to be, if you look at the data from the last 10 years, where 2/3 of all the bankruptcies occur. And so, I think what that's going to translate into is when there is more distressed opportunities, whether it's the big private lenders or the big banks or anybody who's focused on the bigger opportunities, there are going to be a lot of other kind of smaller middle market companies that are kind of left behind and in need of capital.
Basel III too, I think, plays a factor in all of this, just in terms of how that's going to shift and what does the timing look like for how that's going to play out.
There's a significant industry pushback, appropriately so, because if it were to move through in its current format, it would be severely restrictive to capital formation and very punitive. So again, back to how do we feel? I would agree with most bank executives that it's overly punitive relative to the risks they take and relative to the regulatory framework that they're already in. But regulators will regulate, and so to the extent that actually goes through, that's going to be an accelerant to some of these trends that are already happening.
Right. Thinking about companies that are going to come due with refinancing needs, Ty, what does the timeline look like for this in terms of an opportunity in distress?
Yeah, everybody always looks for the kind of the maturity wall. There are a lot of maturities coming up in the next few years. Refinancing is getting very expensive. It's our job to kind of figure out which companies are going to be able to pay the higher cost of capital, because there is going to be a higher cost of capital for everyone. And there are ways to correct balance sheets that are not through the court process, not through bankruptcy. There are liability management exercises. In many cases, we were just talking before the panel, the folks who are participating and leading those transactions are actually working with sponsors to do that. They are working in many cases against other lenders in the capital structure. And so, you kind of have to be on the right side of the fence on that one, and be paying attention so that if you're not on the right side, you're just avoiding the situation at all. So, that's something we spend a lot of time on. But there are going to be, one way or another, there are going to be a lot of restructurings, whether it's in court or out of court, to the balance sheets that we have out there, because there are just a lot of companies that aren't going to be able to support the level of higher costs with capital that they're going to need to be paying.
I would just add, there's a vintage of LBOs that were done in 2021 that were at low rates on companies that were good companies but had unusually high cash flow due to COVID. Michael's Stores is an example of that. And there's a bunch of others as well. So it's not going to happen tomorrow necessarily, but over the coming years, there's going to be a whole wave of these deals. I think that, the VCs weren't the only ones doing sort of ill-advised deals during that period. So I think that's going to be a big source of distressed flow. I
also think there are a bunch of names that people were financing them based on their pre-COVID cash flows. And so now you had companies that have more debt than they had pre-COVID. Maybe they get their cash flows back to where they were or even higher, but with more leverage and higher rates, it compounds to be, a higher cost of capital for their, higher nut for them to meet.
One thing we're looking at, though, in terms of the game theory of how these are going to play out, at least in the sponsor market, Not to say we won't see opportunities in the non-sponsored market, but I think it's important to point out, if you look at the structure of the private equity market today, to Dan's point, you have a whole vintage of invested capital that was put to work at multiples that were probably 2 standard deviations higher than the historical average. However, if you look at it today, you have about $3.5 trillion of private equity that's been invested at uncomfortably high valuations. You have about $1 trillion that is uninvested. So most, if you look at it on an index basis, if you're a private equity firm today, you have about $3.5 in the ground for every $1 that you have to invest. And you're sitting in capital structures that are probably at a 50% loan to value. If you go back to the GFC and prior cycles, they were in equilibrium, meaning you had $1 in the ground and $1 uninvested, and you probably had leverage on your company that was in the 70% plus range and getting worse. So what we are seeing is that the private equity community is much more focused than they were in prior cycles of preserving and protecting the value that they have, and buying time in order to kind of grow into the multiple from that 2021 vintage, which is a completely different setup than we've seen before, because prior cycles, if you were 70% loan to value and your earnings were falling out of bed, you would probably throw the keys to the lender, or you'd help facilitate a restructuring and focus on putting that dollar to work to make money for yourself and for your investors. So there's a different dynamic here with the owners of companies that we're seeing play out from prior cycles.
Well said.
Dan, third point's unique sitting up here on the panel with the equity side of your business. How do you use the equity side of your business to express views in distressed credit?
A couple ways. First, just from, we have a lot of equity analysts that are looking at different industries, who have a pretty good sense of what's happening in healthcare, telecom, in industrials, you name it. The other side of it is it gives us a duration of capital. And this goes back to the earlier days of Third Point, where we would buy loans that would convert into equity. Some of our biggest winners going back to the early 2000s, smaller cap, Dade Behring, Warnaco, International Coal Group, things like that. The distressed investor, the dedicated distressed investor, basically in those days, everything was 5 times EBITDA, and then they were done. Having some duration of capital, but also being able to see them through. And, we had another bite at the apple in 2009, where we played a number of the post-reorg equities. I think now, today we have a few companies in our portfolio, let's say 3, that are long-term holds, really high-quality companies that, because of unique circumstances, had went through a reorganization. In one case, it was an acquisition. So PCG, there were a lot of distressed people. Again, they don't have the patience to kind of look through and hold that for many years. The stock's been at double since we put up primary capital for them to emerge from bankruptcy. Another is AIG, going through an interesting reorg. And the interesting one was investing in UBS. We own the Credit Suisse bonds, the OpCo and HoldCo paper. We, in the better lucky than smart category, we avoided the AT1s. And then we saw that UBS was getting a sweetheart deal. So we've owned that since the days of the merger there. So that's our approach.
I just jump in. I think what this underscores is the ability to be flexible and to play into different parts of the capital structure. In a distressed situation, the one security may have a much better risk return profile than another, and it may be the equity. And so, we play in post-reorg equities. It's not a huge part of our portfolio today, but just having that capability is really important. The world, I think the world is a little too siloed. You have people who just focus on secured loans. You have people who just focus on high yield traded bonds. You have people who just focused on equity. And if you give a loan guy $1, he's going to invest in a loan, or she's going to invest in a loan. If you're looking at a situation, though, you've got to be able to figure out where the best opportunity is with the lowest risk. And sometimes that's the equity. We always say we look for opportunities that have as much upside as downside and a higher probability of achieving that upside. Traditionally in the fixed income market, there's more downside than upside. So, how we make up those returns and how we put up returns that are attractive to our investors is often by looking at lower down in the capital structure, where particularly in distressed situations, you can make a multiple of your money if you get it right.
And just one thing I would add to that that's critically important if you're going to invest in or short equities of heavily levered companies is you need a completely different framework when you think about them. And it goes down to just basic option theory. And I've seen more people carried out because, they saw bonds trading in the 50s and maybe even the 30s. The equity is still at a couple bucks. They're like, well, this is obviously a zero. But what they don't realize is two things. Companies can turn around, Carvana, or the capital structure really represents a series of maturity dates where your equity is a call option that expires at these different dates, and measured with the valuation determined by the volatility and the duration of the option. So when you're short one of those stocks and they roll over a near-term maturity and send it out for a few years, the equity can double or triple on you because people are thinking about it as options. So that's a little nugget. When I talk to people in school, I offer that because it's a really important thing, and people completely miss that.
Yeah, it's a really good point. I mean, I think you're touching on some, broadly speaking, pattern recognition as well. When we were chatting before, as part of our prep call, we talked about frontier as an example as well in the AI space. So maybe we just talk about that a bit too, to just give it another example of what that means in terms of the opportunity set.
Let you guys
go ahead. I think a lot of us are invested in it, but go ahead.
I'm not. So why don't you go?
I called it the sexiest opportunity in AI, I believe, right? Is that the right label?
Well, I think look, pattern recognition, I'm glad you brought that up, I think is critically important. And also looking for, at least particularly on the equity side of the business, understanding where the markets are going to express a view on emerging trends. So not to get into the weeds on a frontier, but you could look at what seems to be a sleepier fiber company, and all of a sudden when we start talking about AI and the digital solution starts to have a set of growth opportunities put in front of it that weren't originally in the investment thesis. And so we are always looking for those opportunities because the public markets in particular are expressing views on larger markets. The private markets don't really behave that way, right? So when we're investing in the private markets, we're looking for what we would call supportive beta in our investing, but it's a very company specific analysis and very company specific underwriting. But I think in the public markets, you get an opportunity to express a view on some of those emerging trends in a way that we can't do in the privates.
Right. Why don't we, just thinking more broadly too about the flywheel effect of capitalizing on opportunities both in the public and the private. Ares is a large shop. Third point, also you're now growing into insurance and you have a BDC. Dan, why don't you speak to how that helps to have all of the different levers that you can pull to capitalize on opportunities?
Yeah, so I think it's important to have sort of this sort of horizontal and vertical integration, meaning, be able to look holistically. Well, we look at it, across the whole capital structure, but also different asset classes of credit, whether it's, our areas of strength have historically been in structured credit and corporate credit, done a lot in emerging markets. We're introducing private credit, but also we started an insurance company in 2010, and it sort of gave me an appreciation for alpha generating opportunities within rated credit too, and investment grade credit. So what we're able to do now is sort of ingest our own exhaust. So we used to just forget about lay off the investment grade pieces, but there's a real opportunity. I think, Mark Rowan talks a lot about, you guys do as well, is the one of the biggest, most interesting, used to think most boring, but now maybe most interesting parts of the market is the investment grade area, and finding these opportunities to create alpha in that market, in structured credit, in different aspects of it, and places you can capitalize on it are in vehicles like annuities and insurance that you get paid to find that extra 50 basis points or 150 basis points, taking a new issue or finding a segment of the market in maybe a private credit loan or a structured credit loan that gives you the ability to earn an outsized return on the equity in that entity on a levered basis. And it actually can create, really, it's interesting. It's sort of like financial, maybe I shouldn't say financial alchemy because that usually ends badly. But, if you can take a series of, high single digit returns and turn them into something that is in the high teens, I think that's a great investment.
I would just say, I think, and Ty hit on it, as these markets continue to grow and evolve, I think it's critically important that you have flexibility of capital, the ability to go liquid or illiquid or senior or junior or debt or equity. These situations, particularly when you're in the opportunistic part of the world, you want to be invested in the right situation. A lot of times when you get involved, you're not exactly sure where that best relative value is going to be, and you want the opportunity to participate in that security. So if you're approaching the market opportunity with one cost of capital or one structure, you're probably going to miss out on a significant segment of the market opportunity. And I also think it's going to force bad underwriting, because to Ty's point, if you have a single cost of capital, even though you will resist it, you will wind up shoehorning as much of your available investment opportunity to fit your box. And that's not really a recipe to generate excess return. So I think over time, as these platforms are growing and developing, people are getting better at thinking about cost of capital and structure, and then translating that into the market. And so the high grade piece is an interesting part of it, because what has happened there is the private credit markets have been able to leverage their origination infrastructure to, again, disintermediate the securitization market and create alpha in a market that was historically, not really viewed as alpha generative. And a lot of that is because we cracked the code on cost of capital and structure in a way that we hadn't before.
Right.
Yeah, I would just add, I think that's exactly right. But in order to have that flexibility of capital, you also need the infrastructure and the skill set. We wanted to double the size of our addressable market, wanted to be able to invest in Europe and in North America and be able to toggle back and forth based on where there's better relative value. So we had an office in London from day one. You want to be able to go up and down the capital structure. It helps to have people on your team who have looked up and down the capital structure, and every senior person on our team has that experience. I'd also say you have to have the mindset and the skill set to invest in things that other people aren't necessarily investing in. We've done very well in certain industries that I generally hate, whether it's coal or airlines, things that present opportunities because they have assets or cash flow, yet other people aren't investing them for reasons that might be ESG, or they just may be, too volatile for them or whatever. You have to kind of trust your work and be willing to invest in situations that, as long as they're priced appropriately, can generate attractive returns. But if you rule out certain areas of the market, it's hard to say you're really opportunistic.
It's a huge opportunity right now. It's a different mindset. In equity, there's a move towards higher quality, better businesses. But the beauty of credit is you're getting your coupon, you have a maturity date. You don't really care how good or bad the underlying business is, as long as you get paid back. And if you're high up enough in the capital structure, I think people hate telecom, people hate cable right now. And we're short a number of those names in equities, but on credit, it's another story, because we think we can bracket where these businesses are going to level off. And as long as we're investing high up enough in the capital structure, there's incredible opportunities right now. And I agree 100% with what Ty just said.
Yeah. Mike, were you going to add to that?
No, I agree. I think it's this idea of optionality that Dan talked about a lot of times also for us in these structured opportunities is how we think about where we're going to attach, and then how much of that equity value we want to be playing for in a lot of these situations.
I'll just say one anecdote to reinforce that, not to cherry pick a good investment, but Vistra Energy was a hated stock. It was a post-reorg independent power producer, mostly running coal-powered plants, and it was a value play. They happened to have made an acquisition of a couple of nuclear power plants, but people weren't giving them credit for it. And voila, I mean, we didn't think of this when we made the investment. It has since become a darling because it has clean nuclear energy servicing data centers. And, going back to Ty's idea, sometimes you make money just looking at the cash flow. Sometimes you get lucky, but you have more opportunities to get lucky when there's a lot of cash flow and duration in the investment than you make if you're just, investing in things that everybody else loves.
Right. Want to circle back to rates and the Fed. Again, we're in this higher for longer scenario. Every signal in the market, labor participation, everything is strong. But consumer spending is strong as well. At what point are we going to start to see cracks? We're in a political environment that certainly plays into what we're going to see in terms of rate moves this year. But how are you keeping on top of this, or when do you expect to start to see an opportunity emerge?
Well, this is what I'm saying. The opportunity is emerging. So, public information, we did a $3.5 billion portfolio trade with PacWest to help them, navigate through their balance sheet issues. We're dealing with banks on portfolio acquisitions and SRTs and CRTs. So there are liquidity-induced cracks that have already emerged, and as rates stay higher for longer, that will continue. So I don't want to give anybody the impression that there's not opportunities to invest because of rates. And I also think, again, because I tend to spend most of my time in the private markets, it almost doesn't matter whether we get 0 cuts or 2 cuts or 3 cuts by the end of the year. What matters is, where do you think the neutral rate is going to land, and what is the path to get there? And I think on any path that you draw from where we are now to the final neutral rate, it is going to create a significant amount of liquidity challenges for a lot of organizations that have inappropriate balance sheets. Banks, they have mismatched assets and liabilities. Companies that over-levered at a lower cost of capital just have, there's a lot of balance sheet cleanup that is already happening. Every quarter that goes by that rates stay higher, that opportunity set just increases.
Yeah, I just make a couple observations. One, I think this Fed in particular, they may have been a little late in addressing inflation to begin with, but they have been more transparent than any previous Fed in history, I think, and they're telling us that they're going to continue to wait to reduce rates. I think they've also been very data-driven, and so we've kind of thought about higher for longer for a while. I still think there's probably a good chance there are no rate cuts this year. As Mike said, it doesn't really matter. While we're waiting, floating rates in particular are pretty attractive, and so in the spirit of being opportunistic, we look at leveraged bank loans versus high yield, and we see high yield as being pretty tight, and spreads are tight, and leveraged loans are pretty interesting. And the relationship today is for leveraged loans are, 75, 100 basis points wider than high yield, when traditionally they've been kind of 50 to 75 tighter. That creates some interesting relative value. The other thing I just want to observe about the Fed and rates, we're kind of in this Orwellian mindset where the market cheers underperformance of the economy because they think that the Fed is going to save them, and that's going to increase the chances that rates get reduced. You know what happens in credit when, if the Fed is only reducing when the economy softens, that doesn't bode well for below investment grade credit. If you look historically at spreads widen out more than treasuries come down when the economy is slowing. And so, high yield doesn't necessarily outperform when rates come down. And I think people kind of forget that. And so, I would say for now, there are a lot of attractive things, particularly in the floating rate market. And I think because of the high rates, there are going to continue to be more stressed and distressed opportunities. And when rates do come down, it's usually a sign that the economy is not doing great, and there are going to continue to be more stressed and distressed opportunities. So, we feel pretty good about where we are and about the opportunity set going forward.
Dan, do you agree?
I think they said it all. No, I think there's good. Look, we're finding here, the situation we're in now. It's a rifle shot market, not a shotgun market. There are specific situations in certain industries that are super interesting right now. This is not yet a 2009 or even March 2020 widespread. Doesn't matter what you do. You have to be really selective. People talk about stock pickers market. This is a bond and credit pickers market, and there's definitely stuff to do. I think what we're talking about is whether there's a more widespread opportunity of distress, and if that happens, we'll deal with it. But I think there's plenty to do now while we wait for that.
Right. Commercial real estate has been branded as last year's narrative. So is there anything more to be said on that this year ahead, or are there other sectors that you're looking at in real estate, real assets more broadly?
I again, great headline, but I don't understand it, because when you look at the embedded amount of real estate, the amount of leverage in that system, you have assets that are not able to service their debt with some secular challenges, right? So to say that real estate is last year's narrative, I think is missing a pretty significant opportunity. Like I said earlier, if you just look at regional bank balance sheets, 45% of regional bank balance sheets are made to commercial real estate loans. With regulatory capital changes, those loans, especially as we get to the maturity wall, will need to get restructured or recapitalized to reflect the reality of the new, rate and cap rate environment. So I actually think real estate, for me, opportunistic real estate equity, opportunistic real estate credit, is actually next year's and the year after and the year after's narrative, not last year's narrative. I think that's going to be one of the biggest value transfers from equity to debt that we've almost ever seen. So I'll take the other side of that. We're spending a lot of time in those markets. And in real estate, unlike corporates, to the earlier comments, when you hit a maturity wall on a property, it behaves differently than when you hit a maturity wall on a corporate, right? A corporate just has many more levers to pull to either cut expense, invest in growth, they have more flexibility around their capital structure. The four walls of a piece of real estate are pretty narrow in what you can do. So if you hit a maturity and you are where you are, that loan is going to get restructured. So we're quite bullish actually on the distressed opportunity in real estate, and have begun to gear up for that.
You also you rarely see corporate cash flows go from wherever they are to zero. Whereas when a building becomes vacant, that their income becomes zero. I think it's also, to Mike's point, it's going to create some really good opportunities in regional banks. We're going to continue to see consolidation, but with so much of their balance sheets focused on real estate, and real estate is, location. It really matters what's in the portfolio. And so for the folks who are spending the time to figure out what's in each of those portfolios, there are going to be some winners and losers there for sure.
Final closing thoughts, the size of the private credit market more broadly, where does it go in the next 5 years?
Next 5 years, it keeps growing. I mean, if you look at the 10-year CAGR for the private credit markets, broadly speaking, has been about 15%. I would underwrite a similar type of a growth rate. So if you said, where's it going to go the next 5 years, I would say that it's likely to double again. And again, every time we say that, the headline pops up that we say that it's going to double, but that's just basic math, right? So when you're compounding at 15%, the market's going to double. So I think you've got real strong secular tailwinds in these markets. You've got real cyclical tailwinds, and the ecosystem around private markets generally has more companies staying in the private market longer, and that compounds. So I think that compounding effect is something that people need to be paying attention to, because when you talk about a market that's grown 15%, it's not like we created a new market. You're just seeing capital shift from one part of the economy into another, and it's compounding. So probably half of that growth was just the compounding effect of the people that were already in the private credit market.
Right, right.
Yeah, I would completely agree. I think the private markets continue to grow. I think even if the public and liquid markets grow at a slower rate, so much of the capital being raised now is for private markets that it creates less focus on the liquid markets and more opportunities for folks like us, which is great. I also think there's going to be, at some point, there has to be a secondary market developing in the private markets, and it's really the same analysis and the same work we do on our liquid credits we're going to be able to do on private credits as well.
Great.
Yeah, I think it's an exciting time. I started Third Point as a distressed credit fund and high yield fund. I came out of the research area at Jefferies. I love credit. I love it as an investment strategy. It's relatively opaque. It's less liquid, but if you have the right kind of capital and you have the skill set, I think it's a great area to be in. And I think this, clearly it's a golden age, but I think it's going to continue, especially for people who have these alternative credit strategies to take advantage of that.
Amazing. Mike, Ty, Dan, thank you so much for being here.
Great. Thank you. Thanks for having us. Appreciate it.
Thank you.